In this video, we're going to talk about Palantir, trading under the ticker symbol PLTR. Palantir is a data analytics company founded in 2003 and is headquartered in Denver, Colorado. It develops software platforms and applications to better understand the data flow and optimize operations. Palantir has an appeal for the market because it does have a solid reputation built on a relatively long period of time and has a lot of established relationships with major federal agencies and has obtained many long-term contracts as a result. It operates in many sectors including automobile, legal, natural resources, and finance. The platforms it develops are Palantir Gotham and Palantir Foundry. The trading volume of Palantir has recently been 41 million shares, compared to an average volume of 37.5 million shares. Over the previous 52-week period, its price has fluctuated between $15.35 and $45. The market cap of Palantir is currently at $32 billion, compared to an enterprise value of $45 billion. The difference between the market cap and the enterprise value, also called EV, is the premium or discount financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. Some of the examples of impact by leverage is if the company has a lot of debt, then the market may feel uncertain about the company's capacity to pay back its interest and principals, which in turn may negatively impact the profitability and solvency of the company. Another key element to understand is the asset composition of many companies. It is especially true for growth-type companies like Palantir that one of the most significant assets they may own is called goodwill. Goodwill is the expectation of the market that a company can generate more profit or at least have more growth than other rivals because it has a good management, stronger brand recognition, bigger online following, and so on. In other words, it's not a tangible asset companies can use to generate more income, but it's often the reason why some companies are perceived to be trading at a discount, because the market cap is lower than the enterprise value, even if the enterprise value includes the valuation of goodwill. In comparison to its historical price fluctuations, the stock is 10.8% higher than the 1-month low, 10.8% higher than the 3-month low, and 10.8% higher than the 52-week low. Regarding the options market, which often gives a hint on the market sentiment on where the stock price is likely going to head toward, the implied volatility is 57.5%, compared to a historical volatility of 46.8%. The put-call volume ratio is currently at 0.53. The most recent volume of options traded has been 159,000 contracts within a day compared to the 30-day average of 174,000. Regarding the open interest, the most recent volume of open interest has been 3.3 million contracts compared to an average of 3.3 million contracts as well. In terms of shareholder structure, institutional shareholders hold about 33% of its outstanding shares. Biggest shareholders may include Vanguard, BlackRock, and State Street. The relevance of the shareholder structure is important to determine if you should hold the stock long-term or to view it as a short-term volatility play. If the company is mainly held by retail traders, then it may be a sign that the stock lacks the depth to justify long-term trust from shareholders. Of course, there are a lot of exceptions from what I said above, but usually the consensus is that it should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a trade. Let's also look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price goes lower. Sometimes, if there are significant short interest in the total volume, it could be a sign that there is an organized shorting operation going on. The current short interest is 6.5% of the total float and about 35% of the dark pool transactions. Now, let's take a look at the indicators. Financial indicators give us a suggestion of what the price movements are showing, and they can be used as one of the elements that determine if our overall approach is the right one. The oscillators are suggesting buy tendency with 1 sell, 9 neutral, and 3 buys. The moving averages are showing an overall tendency of strong sell with 13 sell, 1 neutral, and 1 buy. In terms of pivot points, which are levels of support and resistance sprinkled in the price trends, the support levels are $12.81, $15.89, and $17.79. For the resistance levels, they are $20.13, $22.05, and $25.13. Palantir has been having a fairly challenging sequence of events as of late, partially because it published quarterly results that were below people's expectations in one specific area, and that is the growth of public contracts revenue. As a result of this, some analysts have decided to reevaluate their perceptions of Palantir. Their perception of how much Palantir is worth, and this triggered a chain reaction amongst market participants. Another way to put this is that people have been more reluctant at buying Palantir because the basis on which we evaluated this company has been modified, and so did the demand for Palantir's shares. Palantir is a major public company with material institutional holdings. What this means is that valuations and analysts' opinion do have a significance for those who handle money for others on a large scale. Essentially, portfolio managers do listen to opinions of their colleagues when it comes to buying and selling shares and will decide to modify their exposure in a specific area. From my personal observations, those buying and selling decisions are often influenced by very subjective reasons, like the perception of outsiders when they see the portfolio's holdings from the 13F forms that they file. In this case, the recent sell-off may have been created by the fact that institutional portfolio managers have seen that analysts have changed their consensus about Palantir, coupled with the relatively high valuation that the stock already have, to determine that they don't really want to carry that much exposure in Palantir right now. The recent sell-off may have multiple causes, but in my opinion, the snowball effect probably began with the Q3 results, and it triggered a chain reaction of existing issues regarding people's uncertainties over Palantir's valuation, and this has accelerated people's desire to reevaluate their exposure in Palantir. I mean, after all, Palantir is valued on future projections that were determined in a very favorable environment, and I would argue that this environment may get more challenging as we move forward. I don't believe that Palantir necessarily has a bad business model, but its current valuation has already put so much hope and even hype and speculation on the shoulders of the company that there is a very compelling case for the market to take a break on the buying spree. With that being said, let's also take a look at the fundamentals themselves. Palantir has a software-based business model with deep and long-term relationships with various public and private sector clients. Palantir is likely to eventually make its place and to establish a more permanent and omnipresent influence in the economy of the future. For that reason, I think that the long-term recommendation should be positive and to adopt an overall bullish view. However, in a market condition that is now more challenging for growth stocks, we must also reconsider the timing and the amount of exposure we're willing to put in Palantir. Our portfolio should be ready for the scenario that Palantir may pull back by up to 30% from where the stock is right now. It doesn't mean that the company will necessarily do this, and I don't see any signs that it will as we speak, but it's a matter of protecting our capital in an uncertain market environment. My suggestion is to keep an allocation between 3 to 5% in Palantir, and to buy in very small batches every time the price falls. The current price point is a good entry point in my opinion, and you should fill in at least 10% of your allocation. Your investment should also take into consideration the market conditions and the surrounding sentiment to determine what kind of asset should be picked, for how much and for how long. First of all, the financial market doesn't reflect the real economy. If the stock market is doing great, it doesn't necessarily mean that companies are hiring people, that salaries and living standards are rising. Sometimes it's the exact opposite that happens, because the stock market is a pool of money where things come in and come out, going to different sectors to be placed. The capital may be used to be invested in a company to improve its efficiency and productivity, but it can also be used to buy up shares and assets in order to make a profit. This phenomenon is called financialization, and it means that the more money is being used for non-productive purposes like merger and acquisitions, fees to financial sectors, buying back equity, and so on, the less there is for the real economy. Another way to put it is that ever since 2008, the Dow Jones has increased significantly. But people don't necessarily see this growth in tangible ways. This is why we gotta be careful with the assumptions that rising stock price means better outlook for the company. Sometimes it doesn't mean anything other than the fact that the asset is getting more expensive to be bought and that their yields is going down as a result. Additionally, some new phenomenons are now palpable, such as the creation of new bubbles, the participation and influence of retail traders in specific situations, and the anticipation of a massive recession or at least pullback. Bubbles have always been created on and off over the past few centuries, but nowadays it's quite interesting to see the speed at which an organic bubble can be created back in 2020. Because almost immediately after the major collapse of the financial market back in early 2020, the market decided to pour a massive amount of capital in the EV sector and anything that's related to it. Stock prices went up the sky, and for a moment, it really felt like any EV stock can be a golden goose. Another way to say this is that any SPAC with an EV company in it will become the next Tesla, right? Even if it didn't last that long, this episode definitely allowed the market participants to park a lot of their money in a sector, leaving it with either a lot of profits or at least avoiding incurring large losses because they left their money in the blue chips or the sectors heavily affected. The involvement of retail traders in companies has also been much more pronounced in recent months, especially in the scenarios of a short squeeze. Companies may have short sellers who believe that the stock will decrease in value. The short squeeze consists of buying the stock price up to force the short sellers to recover their positions, which will then also trigger an even bigger increase of stock price as a result. Of course, I'm not saying that this is always rational. I'm not even saying that those companies always have a convincing narrative. So, for example, if you play video games, ask yourself if you personally bought all your games at GameStop, knowing that you can buy the same games just online in the comfort of your home. But nevertheless, retail traders do have a much more significant influence in the stock price nowadays, for the better or worse. Personally, I think that as long as the volatility is high or gets higher, it'll create more opportunities. The final phenomenon is the anticipation of a recession. Many people have been expecting something of that sort to happen ever since 2008. There were quite a few companies that were supposed to go bankrupt because their debt structure is no longer sustainable or that their business model is bad. But overall, the system was able to hold its ground, especially in the North American market. This is partially because capital around the world often choose to come to the American capital market when things get heated back home. This is especially the case when geopolitical tensions increase around the world. In order to make sure that capital can provide a steady return without being affected too much by the central bank policies and inflations, I think that this phenomenon will increase its pace as time passes by, at least for the next couple of years. This is why we will likely see the blue chips continuing their ascension, even if for the growth stocks, things may be a lot more nuanced. The bottom line in all this is that the environment is getting more uncertain and volatile in a context where asset yields will probably remain quite low, because the real economy cannot be improved with just money. As far as we're concerned, this means that the patience would be a great virtue for all of us, and that there will be plenty of opportunities to eye for better prices. With that being said, always make sure to keep your positions diversified and keep the risk level under check. Speculative positions should play a small part in your overall portfolio. I would say it's better to keep them below 10 to 20% of your total holdings. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.